I'm JD Henning, and I've developed this multiple discriminant analysis approach to picking stocks for breakouts. And it started when I went back for my doctorate in finance, and I wanted to figure out if there's another way to figure out stocks that break out without just looking at price changes. There's so many methods out there that are looking at price change to forecast price change. And by that, I mean, you have like the Elliott wave theory, you have Bollinger Bands, you got a lot of chart patterns that people look at, and it's all a matter of price. And I thought, well, what if I went about it in sort of an inductive statistical method? And I found that something called multiple discriminant analysis, and that's where the name comes from for MDA Breakouts. And all that means is I separate stocks into 7 categories. And you can see here on the slide that I wanted to find stocks that were classified as negative reversal, going down, negative acceleration, getting worse, negative control, or just basic your typical negative stock, and then non-momentum control or flat stocks that could we predict if they're not moving, and then positive acceleration and positive reversal. And you'll hear in all of this work, and when you see the automated website that I share on Seeking Alpha and on social media, you'll see me talking about negative acceleration 2 and positive acceleration 6. And it just happens that those are the 2 most interesting categories for investors. You know, they want to know what's going to go to the moon, what's about to correct. And then there's stuff in between that I just kind of lump into a category that shows up yellow in the chart. So it could be positive, it could be negative, it could be flat, but really the focus is just going to be on negative 2 segment and positive acceleration 6 segment. And so I want to give you that highlight of it. The other thing is I used a lot of variables to figure out how that works. And one of the questions I get a lot is this a buy? Should I buy it now or should I sell it now? What are the signals? And I'm not going to get into the weeds on this, but just to show you really quickly, so you have this in your mind when we're talking MDA charts. I broke this up statistically. These are all the stocks in the basic materials sector, and I used, instead of like linear regression, I used multiple regression, and it finds clusters. All right, this is as wonky as I'll get. It finds clusters around the centroids, around the mean of segment 2, which is right here, and segment 6, and those are the ones we're most interested in, and everything else is kind of noise, okay? And what it tells me is the closer they are to the mean of that segment, the more likely they are to break out. And so when we do a chart that says, breakout positive 6, I'm looking for stocks within a certain range of that mean, okay? I'm doing a little circle around 6. And the technical term for that circle is actually called the Mahalanobis distance. Okay, that's really getting wonky. But it's just how close to the mean is it and how accurate will it be? So that's what we're looking for. And on some charts, it's not as clear. And on other charts it is. And what we're doing is we're just measuring the distances in between those stocks. Since then, I've made a lot of progress with the help from Lance and others who have built this incredible website. And what it does is it breaks things down into different categories. And we have at the top, it's the sector gauges. We have the 6 months of the market gauges. We have 6 months of the S&P gauges. I give a little blurb up here about what's going on. And then I have picks that go out every day that come out automatically from the algorithm. And today's picks are here from the market algorithm. These are the picks from the S&P gauge algorithm. And then these are the sector gauge picks from the algorithm. And you can click on each one of these. It'll give you a chart, and it'll also tell you how each is trending. And so this is, at a high level, this is what the website does. And it's all operating off of what I showed you on that strange statistical plot. And here's how it relates on the MDA level. Okay. And this is the progress that I did as I was doing my research to find out what were the breakout stocks. And so, one of the most well-known is NVIDIA, and you can see that it's still in breakout. It just reported earnings, and it's still holding in a positive segment 6 MDA condition. And what that means is up here on the top bar, we have green segment 6. The bottom bar, we have the red, segment 2, and then everything else is put in the middle as yellow, and those relate to those centroids that I just showed you on the sheet there, and that those are the 3, 4, 5, or the reversals that statistically I just put them all together because we only care about the two extremes, the extreme positive and the extreme negative. And you can see very clearly that we were getting a positive signal here, and it's been holding a breakout ever since. Now, what's really important to conceptualize, if you want to answer the question, should I buy this and when should I buy it, is that this chart actually shows you the drift from the extreme negative, how it's moving all the way across through different conditions, and it's getting closer and closer to that segment 6 centroid, or those variables that classify a breakout stock. And what's unique about this model is it's not, again, based on price changes. You know, a lot of people say, I'm not going to buy a stock that's going down. There are times where a stock will be negative, like you can see NVIDIA here, it's going down for 5 days, and it stays max positive on the MDA signal. And what that means is it's still very close to all the non-price characteristics, all the variables that I've tested that say it's a breakout stock. It doesn't mean that people are going to react to these variables the same. They could be selling a very good stock that's still going, eventually going to go higher. And that's the case with NVIDIA. And you can see that signal all the way through time here, where it moves from very positive and then it starts moving into breakdown conditions. And that's the segment 2 that we saw on the statistical plot. So it's really a 3-dimensional analysis looking at over 75 variables. But to make it really simple, we split it almost in half. And we just said, show me the green, show me the red, and push everything in between into the yellow. And that's what this chart shows you. So it's very simplified. Okay, NVIDIA is a great one to look at with that. We also have Carnival Corp. That has another beautiful chart where the signals are very clear and distinct. And you can see the price moves weren't always up, but the MDA values were near max positive. So we were getting the variables that we really want to see. And we're getting another breakout. And then this is one of the stocks, for example, that I pick as a premium portfolio stock that you can buy and hold. It may not do 30% in a week, but it's going to give you good gains, and you can just follow the signals for that. And every stock is different. You can see on the side here, it says S&P 500 gauges, which means it's using the more sensitive signals to pick up movement in large cap stocks. There's other gauges like sector gauges we'll get into, and market gauges that have different sensitivity levels using the algorithms, because some stocks are extremely volatile and they have very different parameters in the variable set. So for the larger caps, it's good to just use the S&P 500 index or in S&P 500 gauges, and you can just see how the reliability on this is pretty strong. Another good breakout one is AMD. We're all following the semiconductors, and this has a very strong correlation, of course, to NVIDIA, to semiconductors. And if you're into ETFs and you're trading something like SOXL, SOXL, that's a semiconductor bull fund, this correlates very highly along with NVIDIA to that performance. And, we're up over 110% in SOXL from the buy signal back here. And you can use stocks like that to inform you on sectors and ETFs. So another stock that we can look at, and this is for like breakdown stocks, here's Moderna, and it's got a lot of red. And you can see how much red is on there. It's been in segment 6. It's almost parked over in segment 2, negative breakdown, for more than a year. And you can see very few breakouts. It tells me that there's a lot of ongoing outflow. It tells me that it's not under a lot of accumulation. It did have a period here of accumulation that took off, but then a lot of the overhead, these prior shareholders who've been losing a lot of money, when they saw the rally, they sold into it. So it takes a while for those kind of stocks to come off the bottom. It has to overcome a lot of psychological behavioral variables. And behavioral variables are also part of this model. I use behavioral, I use classic financial models, and I use technical variables because I think all of those play a part. I don't think there's any one particular school of thought in finance that answers all the questions because it's so complicated. But in this case, the net flow is very negative. And you can expand this out. This is the daily view, but if you pull this out and stretch it, it starts moving into a weekly view. And you can tell it's weekly because you can get multiple signals in the same week. So like back here, you have a green, a yellow, and a red signal. And that shows that the signals were changing daily. But the overall is, you can see how red that is. And it had some strong gains early on in 2024. What I'm doing is I take 75 variables and I give it to the computer to through multiple discriminant analysis. And it's an inductive statistics, which means it determines which variables matter. I don't get to pick which variables matter. And so I basically just said, show me which are the strongest variables that can predict the price movement or forecast what's going to happen. And it extracts it and it plots them all in those 7 categories with all those little dots that I showed you. And it shows the cluster. So without even seeing a stock, if I had the variables of that stock, I can tell you what cluster it belongs to, whether it's a breakdown stock or a breakout stock or, where it is on that's plot. And what this is telling me is out of the variables that it thinks are most important, and in most cases, that's only about 6 or 7 variables out of the pool of variables that I gave it. And it says out of those variables, these 6 or 7 tell me with about 70 to 80% certainty that mRNA is in a breakdown. It looks like all the other breakdown stocks, or it's starting to move over here. And the actual movement is what, people are saying, do I buy it? Do I sell it? Well, it's moving. And you can see it's transitioned from very, very negative here to more positive, and then boom. So if you really want to get ahead of the game, you can take the risk and catch it on a move up. But that's just picking up the new variables, like inflows are coming in and stuff like that. And it doesn't really care what the price is, because the price could be going down, but the variables are all good. It's saying it's still at this cluster, but people might be scared about a news event, and so they're selling it. But the cluster is saying, no, there's still accumulation, there's still good variables. And then sure enough, we see it come back again. A prime example of this is look at this big drop of mRNA, and it stayed max positive. It's not tracking that. It's tracking something else, one of those other variables, to say, oh, now it's left that condition. Now it belongs to a breakdown condition. But up until here, right there, it wasn't negative. So that's good. And we can look at another one. Here's a line. And I wanted to talk about this one because there are times where the model just cannot predict stuff. So I don't want to give a false impression that it's going to solve everything. What we have here is an earnings announcement that surprised everybody, and it dropped from 200 to 140. Short of knowing the earnings, there's no way to forecast what the company's going to say. But you can see up until then, it was a very positive stock doing pretty well, tracking with clusters of segment 6. And then boom, it hit max negative very strongly into a breakdown condition. They can predict the flows. They can detect what other people know. But if other people don't know what the company's going to announce for earnings, then they can't forecast. So it's kind of a forecast of behaviors in the market before it's very clear to other people. And that's a good way to kind of think of it. So that's at the stock level. And then it started to progress with a lot of smart followers of my system asking me, well, if you can track all these stocks, why not do like an advanced decline or a ratio of the positive stocks to the negative stocks and say what's out there in the market and what does that tell us? And I said, well, that's a really good idea. Let's do that. And that ratio became the market momentum gauges. what you see right here. So this is the ratio right now of there are 94 stocks positive and there are 35 stocks negative. And it tells you directionally, is the market tilting more positively or is it tilting more negatively? And it's equal weighted. So we have to be careful that we don't compare an NVIDIA to a bunch of little tiny stocks, because obviously NVIDIA is weighted much heavily on the indices. But at a market level, if you have thousands of stocks, it's looking at over 7,500 stocks, it gives you a pretty good idea of how things are trending, especially if you combine it with the other gauges. But let's start here at the daily chart. And you can see we had a breakdown. Let's just do the year-to-date chart. The year started off with a pretty hard hit, in February, and we had this major breakdown. It was one of the worst starts to the market since the financial crisis in 2008. And it just went down and down and down. And then right about here, we started getting a breakout and going up. Now, it's important to notice people say, well, your signal's a little slow here, and, why didn't you buy it down here? Well, here's the thing. It's defaulted to be a crossover between the positive and the negative signals. So it's looking for a tilt or a crossover between positive and negative. It doesn't stop anybody from saying, oh, look at this. This is near max lows on positive momentum. How many times in history have we ever been at max lows on positive momentum? Almost never. You have to go way back. Here's a max low. So you could go back to these max lows and say, hey, I'm just going to buy. It has to come back up from here. And that could be a better bottoming signal than the standard default crossover. And another one I use is like the negative one. If I see 3 days of a down signal on the negative momentum, that's a good warning indicator. I don't have to necessarily wait for an official crossover and say, yep, it was right. Here I am. But you could be getting in down here. It's just a question of how much risk you want to deal with and where do you want to get in. Now, this is looking at it on the weekly level. You can dial into this at the daily level, the intraday level, and the monthly level. So if you're looking at it at the daily level, and here we are year to date, we get a lot more intraday signals. And you can see how it gets kind of choppy and it's not sure which way it's going to go. And then all of a sudden, boom, it's a strong signal and it keeps going. And that strong signal is measured here. This is the negative values going really high. So we got up to 179 negative, and we haven't been there since, not this year, but there are other times like that. You can also go to monthly, and it's very clean. You have very few signals. If we look at the year to date, here's year to date. We have one signal, buy here. You go to a full year, we had a sell here in November, and then we had a buy over here in April, and we're still in the buy. But you can see how the momentum values, positive and negative, those two segments that we're talking about, how they play an important role on where the indices go. So that's kind of the market overview. And there's a lot of applications for this. For example, if you're holding a value portfolio of stocks, maybe these are breakout stocks that you want to hold for a long time, you can just look at this and say, should I be holding all these stocks in a negative signal? Take a step out from the stock level and look at the macro level. Look at the sector level. Look at the market level, and we'll look at those other sectors, gauges as well. But all of that tells you the overall condition that you're in and whether your risks are good or bad. So the best time to buy would be when the macro conditions, the biggest indicators like the market momentum gauges, are positive and your sector is positive and your stock is an MDA breakout stock, and you'll get very strong gains, more often than not. And we'll look at that. So that's just at the market level. We can also look at the sector. We can look at, here's the S&P 500 gauges. So we just talked about the market gauges. These are breakout stocks at the market level. These are the S&P gauges. So let's look at the S&P 500 momentum gauges. And you see these guys, they are looking at only 500 stocks, but these are the biggest ones. And the cool thing about this one is that they're equal weighted, but they're closer in weighting than the other index. And so I like to use this as a money flow indicator for the markets. If this one's positive, it is almost impossible for the markets to go down. So the biggest sector in the S&P 500 is the technology sector, and it's larger in market cap than 6 other sectors combined. So if you combine the S&P 500 gauges with the technology gauges, you can get a very reliable market signal. And by that I mean we've never had a market correction without both of those gauges negative. Okay, so it takes the mega caps to pull things down, and then it takes the S&P 500 to pull things down. So these are really good signals. And we're looking at the weekly chart here. Let me just show you the year to date. Year to date, same thing. We had this very strong negative signal. You can see the negative momentum line here in red popped up, went way down, max low positive down to 1, and then it picked up. And it's been moving along. And this is the longest weekly positive signal that I've recorded in my data going back to 2020. So I don't know how long it's going to go. It's on to like 18 weeks and 87 consecutive trading days, which is tremendous. So put your sails up, catch as much of the run as you can. But when you start seeing these guys, these down arrows, it's time to be a little bit more cautious. Now, the more signals that align in the direction that you want, because you can be short a stock or you can be long a stock. But the more of these signals that agree, the better you're going to do. It's just, it's well documented now, over 9 years of doing this in live public trading. And I think this is a good opportunity for me to just show you a little history on that. In fact, these are the signals through the worst market downturns. And this was early on when I only had the market gauges. And using the market gauges, it caught all these signals. And this is the COVID correction. It was a 35% decline. And this was the 2018 correction when the Fed was doing quantitative tightening and the market didn't like it. And you'll notice that even in these downturns, there are periods where there's a rally up. And I call those bull bounces or bear bounces, and they can trick you. And it didn't turn positive through these. It just said, no, we're still in the red, be patient. And it's hard for people to be patient with a negative signal when you see, in this case, we saw the S&P go up 9% in one day during the COVID correction. Then the next day it fell 11%. But until you get a really positive signal and it confirms it's over, these gauges will stay right in that segment until the signal changes. And that's the duration. I tried to approximate the positive to negative duration in the blue boxes, but it gives you some idea. Now we can add not only the market gauges, but the S&P 500 gauges. So that enhances the reliability. And then I told you briefly about the technology gauges. So we can go over here. Here's the technology sector. And this is terrific for looking at the mega caps. When you do the ratio of the positive and negative numbers, you want to know how they're changing over time. And you want to know how they're changing intraday. You can do here, zoom in a 1 minute, 3 minute, 6 minute, year to date. So you want to get as much information on how things are changing. It's not just a snapshot in time. And this updates live every 15 minutes or every hour, depending on what scale you're on. You can see here, we just got a positive signal that corresponded right with the NVIDIA earnings beat. So technology is back in positive conditions. It got a negative signal for us back here. And that was the first negative signal since February. And so that was a real warning sign that we could see a downturn. It makes us vulnerable whenever we see the high negative momentum, especially if it's happening in the mega caps. So that's a really good thing to look out for. And again, we go back to the main screen. There's 11 sectors. So now we're down into this section here. We have the basic materials, communications, consumer cyclical, and these are all different sizes. The ones I call mega cap sectors are technology, communications, and we have consumer cyclical. And those 3 sectors there are by far the biggest in the whole market. And those are really important ones to focus on. And then you can see how they're trending and what they're doing. And another example of the importance of the sector gauges is the financial sector. So if we look over here here's the financial sector gauges, and what's important about them obviously is they're focused on the banks, and we're talking about rate cuts, and we're talking about bank solvency and different things that are happening. And if you track, we're in a positive signal for the last 12 days, and these are 12 trading days. And we're also using this yellow line is FAS, which is the bull fund for financials, and this FAZ is the bear fund. And so you can click on either one of those and see how it's going, or you can remove them. It also gives you the option to show the momentum gauge differences, like between the two positive and negative indicators. Just another way to look at it. If we let's go back out to the weekly level, and so that when we scroll back, so here's a very, very high negative. Okay, this is a great time to be shorting financial stocks, and it's coming way down. And we made good money in the bear funds, and I'm doing a sector gauge study right now, and I'll show you that after this, where I'm testing out 3 different funds from each sector, and it's beating the market right now with 39% returns through August. And we're only doing 6 of the 11 sectors. Whoever subscribes to this website can do all 11 sectors. They can do it daily at weekly level signals or monthly. But this is a really good time to buy. And if we switch it over to FAS, the bear fund, it would say buy it here, or it would say buy here, it gained, sell here, and it lost after you sold it. So it's following those signals. Now, related to that, a really good example of this that I want to highlight is we go back here to 2023. And what's significant about 2023 was this was the largest financial collapse since 2008. And people don't really remember, this is when Silicon Valley Bank had a run on the bank and collapsed, and then they got bought out and rescued, essentially. And let me just show you a quick illustration. This is 2023. This is Silicon Valley Bank. This is First Republic Bank and Signature Bank. They all collapsed. And then it's on par with 2008, the global financial crisis. And so that popped up very quickly, and then it went away, but it was severe. At the same time, 2023 was very positive. The mega cap giants were going through the roof. Technology's doing good. People didn't see this effect, but we saw it on the financial momentum gauges. We saw right here, the collapse happened in March, and we were getting negative signals right here on February 24th. And just following the signal, I said, okay, into the bear funds for financials. And, we flipped this around, put it in the bear fund, and it was a really big gain. I think it was about a 50% gain from here to there. And then it tells you to sell it. If you use 3X funds, it's triple that. 2X funds, it's double that. You wouldn't even expect it because at the time, the market wasn't doing that badly. But the financial sector is a small sector, and it doesn't really affect the major indices. But you can see when something big comes along, and all of a sudden, all the financial sector stocks are contributing to these really high negative momentum gauges. And that's one example. Financial is also important for other reasons, but that's a good one. I mean, people could, just like some people could trade on one stock their whole life and just swing trade it, you can do that with sectors. You can just go bull bear fund sectors that stick with the ones maybe that are more volatile, and then ride the signal changes. So you can see where there were spikes all through here, and then how they come back down. Again, you don't have to wait for the signal to come all the way back down and cross. If you know it's coming off of a max negative range, you can get ahead of that signal and buy right here. And so if it's a difference of buying it at 125 versus a 30 or so, whatever that signal is, 140. So, and then it went up to 173. So that's how timing is. And it really relates back to that little crazy plot, the statistical chart I showed you, of these clusters of stocks moving around from one centroid to another, and we're just trying to anticipate where they're going. I wanted variables to predict the change in price. I didn't want to go back and take the change in price to try and predict the change in price. That's circular logic. I'm trying to do something different and trying to anticipate it. And I'm not the first one to do this. It's just a different approach to it. There's a lot of methods out there. Peter Lynch was famous for doing his prediction of non-price by going to the mall. And he would see where his daughters would go shopping, and he would look at foot traffic. And that's a perfect example of non-price variable predicting price change. And so what we're kind of doing is we're looking at foot traffic, we're looking at investor behavior, we're looking at earnings, we're looking at other fundamental technical and behavioral variables that give us a little bit more insight of what's attractive in the market. And that's the other thing is if people aren't interested in buying something, it's not going to attract a higher price. A lot of people see a stock that's going straight down. They're like, is this the time to buy? Is this no, people look at that and say, that's unattractive. There's a lot of price seekers out there that are looking for at least the first bounce. And, you can get in on that first bounce by looking at these gauges and seeing, oh, look, it's no longer max negative. It's starting to turn positive. And you get a little more confidence that it's a safer probability. None of these things are guarantees. And there are external factors like earning surprises, CEOs who get in trouble, FEC investigations, SEC violations, all kinds of things that can happen. And so we're just doing the probabilities, and that's really can increase your chances of good returns. And related to that, I said I was going to talk a little bit about the ETFs. I have, over 3 years of data to analyze the different sectors, and I put an article here on V&M Breakouts. It just shows a sample of bear funds and bull funds, and there's usually more bull funds than bear funds available to invest in. But they're all managed by different managers with different ideas of what's going to work. And you can see the performance in the healthcare sector is very different. And so I was plotting these different returns and seeing, which ones to go with and how to go about it. So when there's a positive signal in healthcare, I'll buy 3 of these funds and I'll try and guess which managers got a better program going. And then I'll ride that signal. And then if it switches on the signal, then I'll go to another fund manager. And so I did this and I've quantified it. The returns using the gauges greatly exceed trying to just buy and hold one fund without following the signals. I mean, that seems intuitive. Buy and hold doesn't work if you have signals that work. And you can see, bear funds are not something you want to stay in very long. All of them have losses in a buy and hold approach. You can read the article later, but it's very red here, buy and hold. Here, these are some of them are positive buy and hold, but they're not beating the signal. You can see, NVIDIA. There's actually ETFs on NVIDIA and on Tesla, but you just have to keep in mind that they're just taking the individual stock price and they're leveraging it. So, if you're trading an NVIDIA 2X ETF, you want to focus on the ETF or on the NVIDIA chart. You don't want to be looking at necessarily the technology chart because you have a specific chart you can follow for that ETF. And so these are just some of the signals and things that we use. Also, there's a whole history of breakout stocks over and over and over again. You can follow the signal, you can get the returns. And, for my own public testing, I just picked an arbitrary 1 week period. And I said, okay, for 1 week, before I even developed this website and automated it, I just said for 1 week, I'm going to measure how many stocks break 10% and then how much return I get for that week and see if all my work is even worth pursuing. And, early on I was getting, really good results, but I didn't have a way to visualize it. I just had the percentages and people say, well, what's your back test? What's your, show me back 3 years, how would this stock do for 5 years? And I said, well, it doesn't quite work that way. You can't back test my returns. You got to back test the stock. So here's the stock signal. How do you back test my signals? Well, I guess you add up wherever they were positive and negative, and that's how you can back test now. But that's a common thing. Like, how do you say you have 5,000% minimal breakout returns over 9 years? How do we back test that? How do we verify that? Well, I'm not even holding these stocks for more than a week. There are stocks that are, of course, NVIDIA is a perfect example. Any stock I'm testing, I don't hold it for more than a week. If you held this from May to now, you're almost, you're up 80%. So there's ways to measure it. I don't want people to get bogged down into my 5,000% minimal return based on the weekly thing, because it's not about fixed holding periods. And it's also not about buy and hold. The whole point of signals is to use them to your advantage and get out. At a minimum, get out when everything's going negative. And a lot of people thank me later. They're like, I don't want to do bear funds. I don't want to do shorts. That's all too complicated. But you kept me from losing half my portfolio. I still have my capital, and I'm right back where I was. Now the signals are green again. And so that's good enough. Go to cash. I mean, there's a lot of ways to do it. Here at the stock level, you can say, I'm into cruise lines. Let's just say I want to buy cruise lines. Well, you've got a lot of good cruise charts. Here's one, Carnival Corp. You can focus on when it's positive and just stay in it. And, if you get multiple 90 plus return, here's the scores, 100, 60, 80, 96. If you're getting very high positive segment 6 values, you could stay in it and just keep adding to it. A lot of people add into positive momentum. If you start seeing it dwindle off, that can be an early warning sign, like over here, that it could be headed for the red. And you don't have to wait till it's red. You can just start scaling back. So one of the things I'd like to do in the future is tie all these signals directly to a trading account. And as it's at 100, I'm at 100% invested. And as it drops to 68 and 40 and 20, my portfolio scales. Because as we talked about with those plots, with it moving from one segment to another, it's also moving from more positive to negative momentum. And you can see it on the return. It's coming back up again. And those are ways to do it. So you can do it at the stock level for timing. You can do it at the sector level, as we talked about with, like, here's technology. Get out of technology while it's doing this all the way down to April. And then you can do it all the way at the index level. You can do S&P 500. Say, look, I just happen to be in S&P 500 stocks. I'm not going to buy if the signal's negative. And then you have to decide, are you going to follow this on a weekly level, on a daily level? And you can go from there. So here we are. We're up to 88 days of a positive signal. This is the longest ever in my data. So you can use this as a big gauge. And then lastly, you can use the market. The market gauges will give you the full overview. And we're at 92 to 27, which is extremely positive conditions. This is a good time to buy. All the sectors are positive up here. The really important bellwether sector, technology, is improving. These are really good conditions. And, there's no guarantee what's going to happen tomorrow, but the probabilities are extremely high that we are into some good upside, especially now that we're past the NVIDIA earnings and that they beat. And they also announced a $60 billion buyback. So all of that's going to propel the markets higher. And so that's an overview of this. You can also get alerts up here that will text to you or email you when the signals change. And we're thinking about adding more kinds of alerts to it. But right now it's the market and the S&P gauges at different time intervals that you can choose. And then, so that's it in a nutshell.